Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly update with our friend Martin North. How are you today, Martin?
Pretty good, Alex. How are you going?
Very good, thank you. So it's another interesting month with lots going on around the world, central banking and housing. So how have you seen things since we last spoke?
Yeah, well, I think you can summarize it pretty well as saying things are a little worse than people perhaps expected they would be. Things are moving faster, and essentially central banks are scrambling. Households are pretty twitchy, and there's now more talk about negative interest rates and zero interest rates than I've ever seen. So we're at a very interesting stage, and I suspect the next 2 to 4 months will be really interesting.
Yeah, it's always great to know that we're on the same wavelengths on some of these topics when I have my talking points and then you send through some of your slides as well. So we'll get into those. And the first one here is the business cycle and Australian PSI. So do you want to talk everyone through that?
Yeah, so I thought what we do is let's look at the sort of the four elements, if you like, which are driving economic growth in Australia:
Yeah.
business, consumer, trade, and then government spending, right? Because that's essentially what the economy is. And if we go through it, the first one is business, and this is the PSI, which is effectively a sense of the pulse of business. And unfortunately, the data that came out earlier this week showed that business is really struggling. Now, some service sectors, like in the healthcare sector, aren't doing so bad, but retail is looking really, really sick. And interesting, of course, last week, David Jones claimed that retail was in a recession. I think it probably is. Households are just not spending, right?
Yes.
And the problem is a lot of other business sectors are reliant on households going and spending. So what we're seeing from our SME surveys is that businesses are really now quite paranoid about what's happening. And essentially, we're seeing lower and lower levels of momentum in the business sector. Now, some businesses are still borrowing, but they're not borrowing as far and as hard as they should. And so if you sort of tick them off one by one, the business sector going negative, and that's very important, understanding the dynamics ahead.
Yeah, we've discussed this many times that we've become a very service sector driven economy. So when people start to cut back, it sort of the flow on effect of that business not hiring people and it all cascades.
Well, that's true. And of course, the point is there in a service economy, you're just passing a dollar across from one to one to one. There's no value add. And, the fundamental question is, where is the value add out of the business sector at the moment? And the answer is there isn't one.
Yeah, for sure, for sure. So next up here, we've got that household confidence. And is this data a little bit lagging, or we would have hoped to see more of an uptick with the adjustments we've had?
Yeah, so this is right to the end of July. So this is really hot off the press. And there was a very slight sort of movement around the election, but post that, the two interest rates are regarded very strongly as negative. Partly because you've got 3 million households are absolutely reliant on savings. And of course, savings rates are being murdered at the moment. But others are also, even if they've got a mortgage, are saying, well, my mortgage might be a little bit cheaper, but the cost of living is still rising significantly. And I'm worried about the broader economic indicators. I'm worried about my job. I'm worried about cost of living rising. So, yeah, unfortunately, the confidence index from our surveys is as low as I've ever seen it. And that is one reason why it is that households are not spending, because they're just not satisfied that they know what's going on. They want to save if they can. Many others are actually raiding their savings just to keep their household budgets going. So unfortunately, I think the household sector is going to weaken ahead.
So would you expect that to uptick with the tax cuts we're getting, the interest rates, or if we would have seen that, we would have already seen it?
I would have expected some recovery if we'd have really seen those coming through. I mean, already we're seeing households are saying, well, I've got a little bit of money from interest rate cuts, and, some people are getting taxed. Maybe the next couple of months we'll see that moving up slightly. But the trouble is that jobs and costs and other things, and let's say the 3 million savers who are seeing their rates dropping, that's a very big drag on the overall confidence index.
For sure. So third up here, we've got the households again.
Yeah, so this is now the other dimension. So this is looking at mortgages and mortgage stress, and mortgage stress unfortunately went up again last month, 32.1% now. That's the highest it's ever been. So, again, it goes back to households have huge amounts of debt. Mortgage rates might have slid a little, but their financial footprints are looking pretty worrisome at the moment. It's simply because the cost of living continues to rise. And you can look at everything from health insurance through to childcare costs through to electricity. Fuel, of course, was a big one last time around. That put a 10% jump up in Sydney, for example, or maybe even 11% in Sydney and 10% nationally. Fuel costs are really rising quite quickly because of what's happening internationally in the exchange rate. So, yeah, this is part of the broader story that people have big mortgages, their incomes are not growing, their cost of living are under stress, and the small cuts in interest rates that have been flowing through to some households haven't really made a big dent. Many people have tried to refinance, but can't refinance because they're now in negative equity. Their interest rates are a lot higher, and therefore they're not really seeing much benefit of those rate cuts as well.
Yeah, sorry, Martin, it threw me a little bit. There was two number twos in there, but they're both related to the household sector. But is that something again that we would expect to settle down going forward, or is that one of those ones that we were talking about last time is more of a lagging effect?
Well, I would expect to see some of the impacts of lower interest rates working through positively to mortgage stress. That's what I would expect, but it's being overtaken all the time by the cost of living getting worse, right? And, the Hilda data that came out a couple of weeks ago said there's been no real income growth since 2009 for most households.
Yeah.
I don't think that's the problem, right? So effectively, you might see a little bit of relief from mortgage rates being slightly lower. But in the scheme of things, you've got to look at households holistically, and their overall financials are actually looking pretty sick in many cases, and that's why they're not spending at the shops.
Yeah, for sure. Okay, so now we are up to point number 3, which is trade. This is one that's very interesting, and I know you've got some other slides coming up because we've actually had a record surplus. So it's great for the government, but not so great for those households that are ones trying to pay down their debt.
Yeah, so just to be clear, this is the third dimension. So we've looked at businesses, we've looked at households from 2 dimensions, and now we're looking at the trade. And of course, yes, it's a bumper month. There are 8 billion trade balance. And, interestingly, it's the imports were relatively flat. And that is because essentially businesses are not wanting to ship in raw materials and products because they're not sure they can make much of it because nobody wants to buy them. But exports were booming. And of course, exports are booming partly because of where the iron ore price is and the fact that we've been exporting massively, specifically iron ore, to China. Brazil, of course, had that issue with the Vale incident last year, so they were taken out. China's been buying a lot of iron ore. But, of course, the question is how sustainable is that? And if you go to the next slide, you can actually see how those exports were actually constructed. You can see how the earnings were really driven by the metal ores, right? Massive climb. And that's directly correlated to the high iron ore price because it went up to a very big number, and we'll look at the next slide in just a second. It's also worth highlighting that we've also got, coals and fuels there too. But really, it is the iron ore sector that's really been outperforming, and that's all to do with China. Demand from China has been strong. But of course, the question now is what's going to happen ahead, and that's really what the next slide is on about. Because firstly, if you do look at the next slide, you'll see that the iron ore price is now coming back. It was well over 120. It's now below 100.
Yeah.
And demand from China could well be easing, partly because of the trade wars, and partly because there are other providers now of iron that are essentially now coming on, like Malaysia, for example, and other places, because at the price that iron ore was, they could then make a profit too. So I think we're seeing, significantly easing demand. The other factor, of course, is that China is actually slowing imports. So in their latest data, that was one of the other things. So they're taking longer for that iron ore to land. So that's another reason why I suspect that this trade balance may be a peak.
Yeah, and I just want to rewind 2 slides quickly because that imports really highlights what we're talking about with the consumer-led economy, where companies are buying more things to increase their inventories because consumers are buying, and it all has the flow-on effect. And exports rising is great, and that's a big number. But again, we'd expect maybe some high-paying jobs to come out of that if this was a trend, like a new mining boom. But I just don't think that's the case. I think it's the exception, not the rule.
Yeah, I think you can pretty much attribute it to the very significant iron ore price, which is directly connected to what happened in Vale. And, now other markets are responding. China's coming off. So, yeah, this is a seagull gift, I think you could say, but it's not really structurally wired into the economy ahead. And if you go to the next slide, you can see there the iron ore price is definitely now weakening.
Yeah, and that was something that I know we've both been warning about, that we don't want the economy to rely on. So next up here, we've got the Aussie dollar. And again, during the resources boom, that was one of the main drivers of a high Aussie dollar. Yet here we are with a lot of resources going up, and yet the Aussie dollar is at 10-year lows.
Yeah, and so there were a few things going on here. It responded very negatively to the hype in the trade wars. Basically, Trump has said he's going to expand the tariffs. Essentially, it's pretty much all goods coming from China into the US, specifically now focusing on consumer goods like, Apple products and those things. So effectively, electronics will now be hit. Now, that's going to put higher prices onto goods into the US, which will potentially lift costs in the US. It will potentially put pressure on exports from China. And so our dollar responded negatively to that, not least because then China effectively said, right, well, if you're going to do that, then we're going to mess with our exchange rate. And they actually moved the yuan higher to more than 7 to US. And that's now been triggered the claim from Trump that China's manipulating the currency, which is a formal term, which means that they can now go to the World Trade Organization and accuse China of actually effectively breaking the rules. China says, no, we're not. We actually just have stopped controlling it and allowing the market just to find its own level. So that was the second reason why the Aussie dropped. The third reason was that in New Zealand, they dropped their cash rate by 0.5%, down from 1.5 to 1% earlier in the week. And the Reserve Bank governor over there talked about negative interest rates and the fact that almost certainly that's what they will have to do ahead. And that was really signaling another significant issue. That's only the fourth time that actually the Reserve Bank of New Zealand has done that. They did it after 9/11. They did it after the Christchurch earthquake, for example. So this is now signaling another crisis. And again, the Aussie dollar responded by going down. And I suspect it will go low. We've said this a few times over recent months, right, that the long-term trend is definitely down. But this is a big shock because the move was quite strong and quite quick.
Yeah, for people at home, the fourth time they've done a 50 basis point cut, which is the RBA haven't done that yet. They've been quite slow and controlled. But I think this was a great example of central bank saying, okay, well, something's wrong. There's no point just doing slow and steady. We want to cut and we want to be at the same rate as Australia. And this is where it goes into the currency wars of we don't want anyone to have a bigger advantage over us. It's now a race back to zero. We'll talk about the China. I think you've got the slide coming up maybe. But that peg, when it lost the 7 mark and Bitcoin and gold reacted strongly, it's so fascinating to me to watch this all play out.
Yeah, and there was a race at the bottom, right? There's a race to take the currency down. There's a race to take interest rates down. We are now entering, if you like, what I call the closing stage of this cycle in terms of trying to keep the bubble alive a bit longer. And everyone's now throwing the kitchen sink at it, but the fallout and the consequences, I think, will be very significant.
Yeah. So we've got government spending, and this is something that we do want them to increase, I think, and particularly with big surpluses. But what are your thoughts on all this, Mark?
Yeah, so going back to the four drivers, the fourth one is government spending. So we know that there's been a lot of infrastructure investment, and that infrastructure investment has been made possible both at a federal and a state level, predominantly because income tax receipts have actually been growing. Now, what's interesting, of course, is that the government is very precious about the promise to deliver a surplus, right? And so what they're doing is trying to actually engineer everything to make sure that they can actually say, see, we delivered a surplus, we have no debt. Now, in this current environment, you've got to ask the question, is that a sensible strategy, right? Because we've got significant tax revenue coming in. We know that there are significant issues. We know that the other sectors of the economy, so consumer sector, business sector, and potentially trade, are potentially at risk ahead. So it raises the question, should the government actually be spending faster and harder and effectively sacrificing its surplus while they've got the opportunity with interest rates so low? So this is now, I think, going to be an interesting policy discussion. But clearly at the moment, the government is saying, no. Number one is making the surplus. So that's really driving policy at the moment.
Yeah, I completely agree with that. And around the world, there's a lot more indebted governments than Australia. So there's no point if they get that surplus and have a bit of a hooray if the economy is just falling apart and going into recession, which is the way I think about it.
I think that's right. And, you can look at the next slide, right? So home lending, right? So it's really interesting. You'd have thought from the reports that home lending was booming, right? But actually, no. If you look at it in real terms, this is actually from Westpac. I quite like the way they present this. So this shows that the foreign buyers are 83% less active than they were at their peak, right? That first-time buyers are 12.5% less active than their peak.
Yeah.
That investors are 48% less active than their peak. And upgraders, there's a slight uptick. In other words, people buying bigger properties, but they're still 21% lower than the peak. So it's true to say that home lending is still very weak. And that's one of the reasons why I continue to believe that home prices will not go very firm in many places. There might be a few odd locations, but generally, home lending still very much on the back burner.
Do you think that uptick in the upgraders is an example of maybe the super wealthy not really feeling it as much, and now that houses have come back, they can upgrade and buy a better house that's now even cheaper for them?
Yeah, so some of the surveys data, which I'm going to publish in more detail next week, shows that in fact it is the more affluent households who are less being burnt by the current financial situation that they're in, are actually taking the opportunity because prices have in some cases dropped 15, 20%. And so if you're not too worried about needing a mortgage, for example, or even if you are and you've got a lot of cash coming through, you can get a really good mortgage at a low rate. So they are the ones who are looking to buy and upgrade and effectively move up into the top end of the market, perhaps. But if you look at units, they're just going nowhere. And in fact, the latest issues relating to poor structural quality of many units and flammable cladding is putting more downward pressure on the price of units. We're seeing a lot of prices falling in the urban fringe where there's a lot of new construction still underway. And so, this is very important to understand that the total market is not going anywhere, but there are a few little pockets that are looking slightly more positive. But I find it very hard to really see any evidence to support a significant bounce back in the property sector at the moment.
Yeah. So we've kind of touched on this already, but yeah, the mainstream narrative is, some people have already called the bottom and talking about this recovery. These stats maybe show otherwise.
Yeah, so the point is, there is a significant fall that's happened, and the CoreLogic data here is quite useful because it gives you a long-term view, right? So you can see how long some of these falls have been going for. Perth is, of course, the standout, right? But the change in real dwelling prices from their relative peaks to June is pretty astonishing. Perth down 36%, Darwin down 39%, even in Sydney down 17.9%. And Brisbane 17.1%. So, these are big falls. And even now, the point to make is that on a relative basis to income, prices are still very expensive. So, in fact, if you wanted to get back to levels of house prices that were more in line with income, you still need to see prices come back even more. Now, there have been slight adjustments sideways and in some cases slight movements up, but only very, very slight. And almost nobody now who I think is serious about analysing the market is saying this is going to be a significant rebound. If anything, it's going to be L-shaped. In other words, that might go along sideways and just up very slightly. And my own view is maybe for a little while, but I suspect that the international context that we touched on will come over the top and prices will slide again.
Yeah. So this is the international context that you just touched on then, and it does show that Chinese yuan weakening versus the US dollar, which we spoke about before. Anything else to add to this, Martin?
Yeah, well, I just wanted to make the point. It's really interesting what's happening in the US. So, and this is a Bank of America Merrill Lynch chart that showed that basically the Fed eases, that runs into market strengthening. That then stimulates more tariff activity, that weakens the economy, and you go around the loop again. So in other words, the Fed is effectively now bailing out Trump's tariff strategies by effectively, being prepared to take rates lower if required. That is a really interesting cycle. That's what's going on. And the interesting thing also is that, the yuan is now, above 7. and again, to emphasize the point, China is saying it's not that we've manipulated the market. All we've done is we've stopped some of the stuff that was going on, and that we're now allowing the market to find the true price. And so it'll be very interesting to see how this all plays out. My own view is the currency wars have only just started.
Yeah, they're basically saying, well, we're not going to defend that floating peg and keep selling treasuries. And in the background, they've been buying gold, and we see a lot of the population turning to Bitcoin as well. But I think the Fed and Trump tweeting at each other, I mean, it's just, who would have thought that any of this would be happening?
It's a real, if you wrote a book about this, or made a film of it, people would say, no, that can't possibly happen. Reality is even more weird than, what you might think is a good story.
Stranger than fiction, for sure.
So, and if you want stranger than fiction, then look at this chart here, right, which is effectively how low will rates go, right? So the Danish 10-year government bond is down now minus 0.5 something, right? Think about that, minus 0.5, right? So in other words, investors are happy to not get anything, right? Now, what is also interesting now is they've now started offering mortgages with 0 or negative interest rates.
Yeah.
Think about that. So essentially, if you're in Denmark, you can get a 10 or 20-year 20-year loan and not pay anything. Now, there'll be fees and other things, but this is remarkable. And the point is that this is how this is going to all play out unless we're really, really careful, because negative interest rates basically makes saving stupid, because effectively if you have money in the bank, it's a tax on that money.
Yeah.
And if you can get a mortgage for 0, of course you're going to buy it, and that's going to push home prices higher. So this is now at the most extended end of how this monetary story plays out. And I think Denmark is a remarkable example of what we could see here down the track.
Yeah, and people tend to laugh when we speak about negative rates or negative mortgages and say, Alex, that would never happen. But we're seeing it unfold already. And I think for people, it's kind of that light bulb moment when they realize that this whole system is about debt. Why is a bank paying you to take out a mortgage? Because they're so desperate to keep the debt expansion going.
Yeah, and what they often are doing is getting even cheaper money, so -2, -3 from the central bank. So they're basically still able to make a bit of a turn even at that level.
Yeah.
But, it makes no sense at all in terms of how standard economics works. It really just turned the whole thing on its head. And this is an experiment, right? And the point is, this experiment is a continuation of what happened in 2007, 2008. Nothing was ever solved. All we've done is to continue this weird process of trying to take rates lower and lower and lower. And essentially now we're 0 bounds and below. And so all the story is now about negative interest rates. And that really takes me to the last slide, right? Because here's the thing. In a negative interest rate environment, if you hold money in the bank, right, you effectively are going to have to pay a tax on that money. So just keeping money in the bank, you don't get interest on that deposit anymore. Effectively, they'll take money off you, right? And that means that if people want to hold value, they'll want to take money out of the banking system, right? And they'll want to put it somewhere else. And they might well put it in Bitcoin, or they might put it in gold, or they might just hold it as notes, right? Because in a low interest rate, negative interest rate environment, holding those notes, that still holds its value, whereas if you hold it in the bank, it doesn't. Now, the critical thing to say there is a bill was published just over a week ago by Treasury that basically said they want to restrict cash payments above $10,000.
Yeah, I did cover this on the channel and point people to your video as well. Yeah.
No, like I say, you did a video on that, absolutely right. But it's amazing, right? Because people are not drawing the connection between monetary policy and the cash ban, right? And so there's a very, very short window to try and actually, resist this, because frankly, once it's in, they can then tighten the screws further, and basically people are going to be trapped in the financial system and essentially will be taken to the cleaners because their deposits will reduce in value. They'll be essentially be able to borrow at very, very low rates, but the whole thing is nuts. So, this is a really important, critical, pinch point, I think, in terms of the cycle and monetary policy. And I'm just amazed that there hasn't been more mainstream coverage of the true connection between the cash ban and upcoming negative interest rates. The IMF papers make it quite clear. If you don't have a cash ban in place, and if you don't control cash in the economy, you can't go negative because people will just pull money out.
Yeah, and people say, oh, $10,000, I'm never going to pay for anything with that. But then down the line, negative interest rates, you say, well, I'm going to pull some money out. And they say, well, you can't take that much cash out. Or if you do get cash, they'll charge you minus 2% to get the cash out. And then you'll go and spend it at a shop, and they'll implement a new GST on cash, and it'll cost you an extra 2%. Now, how do they do that against gold and Bitcoin? I'm not really sure. But I guess I just encourage people to get educated on the possible avenues, whether or not you like Bitcoin or gold.
Yeah, and there's a couple of videos there that we've done with John Adams and with Robbie Barwick to try and explain this, because effectively those clauses allow them to potentially bring it in to cover gold, bring it in to cover Bitcoin. It's not totally clear, but this is something which, frankly, touches on our civil liberties. Basically, it will stop you doing the things that you perhaps would want to do. And so I think this is a big deal. It's certainly bigger than just anti-money laundering and terrorism. And frankly, if you think of the total losses from money laundering, most of that's in corporate land. It's mostly in the big organizations and their advisors, the big accounting firms, rather than down in this sort of sector. And what's interesting, of course, is that the policies and the Black Economy Task Force, guess who wrote this? It was one of the big accounting firms. So in a way, it's all part of this story of effectively, households being right in the front line of all of these issues here. And frankly, the buck stops with them. And I'm not sure that's fair.
Yeah, and we have the conspiracies that the bankers run the world and they're above government. But what this is doing is forcing people to use the banks, which are a private system. So, some people, older people may necessarily have bank accounts and cards. They like cash. All of a sudden they find out they're getting charged $10 a month and customers have no choice. It really is crazy where this is all heading.
Yeah, it is nutty. I sometimes say that we are in Alice in Wonderland monetary policy, right? And the problem now is that this will play out over the next 2 or 3 years, maybe 4 years. This is going to go strongly negative. All of these things will play out. It's very hard to resist it, but this is something which is actually being driven not just by our local Reserve Bank, but by the IMF, by the Bank for International Settlements and the other international bodies. So there's effectively an aligned thinking amongst pretty much all central banks. And so essentially we're just on the receiving end of, frankly, what I think, and my own opinion, and I could be wrong, but my own opinion is this is dumb strategy, dumb policy, and it's not going to end well.
Yeah, one of our most important updates, I think, Martin. So I hope you guys have enjoyed that, and thanks so much for joining us.
Thanks.
Cheers, guys.